Will a Santa rally save your portfolio, or are we about to get Rudolph kicked in the teeth? Tom Nash says he has a critical warning for every investor. Let's see if that warning actually holds up when we drag some data into the room. Welcome back to the comment section with Thomas Paul. Today we're reacting to Tom Nash's video, Important Warning to All Investors, where he basically says there are only two kinds of people left in the market: those terrified of a December crash and those terrified of missing the Santa rally of a lifetime. He lays out a pretty specific script: quick 2 to 4% drop on the S&P to shake out weak hands, then a 5 to 15% melt up in the last couple weeks of the year. He says fear is at max. The Fed just opened the floodgates, and institutions are engineering this whole thing like a Marvel villain crossover. So in this episode, we're going to walk through his predictions, check what history and actual data say about Santa rallies, fear levels, Fed policy, and institutional behavior, and then I'll give you a calmer, more boring, much more useful playbook for what a normal human investor should do. Let's start with Tom's main storyline, the glorious Santa rally. Tom's core thesis is, we'll get a little pullback, then a powerful end-of-year surge because the last 10 to 14 days of December are one of the strongest periods in the market, and this year is basically a normal year, so the pattern should hold. So, what is a Santa rally actually? In market nerd land, Santa rally has a pretty specific definition. Historically, it's the last 5 trading days of December plus the first 2 trading days of January. That's how the Stock Trader's Almanac and a lot of research shops define it. If you look back over many decades of S&P 500 data, that 7 trading day window has indeed been stronger than average. Depending on the time period you use, the average gain is usually around 1 to 1.5% over those 7 days, with a majority of years being positive. That's better than a random 7-day stretch, but it's not some automatic rocket ship. And it does not work every year. In some years you get flat, even slightly negative performance in that Santa window. In others, macro events or big earnings misses completely drown out the typical seasonal pattern. So is the last 10 to 14 days of December one of the strongest periods? Directionally, yes. Seasonality studies by places like LPL Research and others show late December tends to lean bullish on average. But that leads to the bigger issue, calling this year a normal year. That's not a technical term. Whether a year is normal depends on things like where interest rates are, how inflation is trending, corporate earnings, geopolitical shocks, and how stretched valuations and positioning already are. Those things matter more than the fact that Santa historically brings a 1 to 1.5% average bump. So my verdict here, Tom's not inventing the Santa rally, the pattern is real and documented. Where he leans too hard is acting like seasonality alone makes a big late December rally almost inevitable and calling it a normal year like that's a green light. Seasonality is a tailwind, not destiny. There are plenty of years where macro just says nope. Stay with me, because his next piece of evidence is max fear, and that needs a reality check. Tom points to the CNN Fear and Greed Index and says something along the lines of, it's at 36. This is max fear. Extremely bearish, which means there's this big wall of worry for the market to climb before it rips higher. Let's unpack that. The CNN Fear and Greed Index is a composite indicator that ranges from 0 to 100. It uses 7 components, things like stock price momentum, junk bond demand, market breadth, volatility, safe haven demand, to produce that score. Typically, 0 to 25 is labeled extreme fear. Around 25 to 50 is fear to neutral, 50 to 75 is greed, 75 to 100 is extreme greed. CNN's own descriptions usually flag the low 20s and below as panic territory. So a reading around 36, that's below the midpoint, so yes, it suggests some caution, some unease. But max fear? No. We've seen readings in the single digits and teens around actual crises. COVID in March 2020, the 2008 financial crisis, big shock events. Those are your everybody is throwing up in the trash can moments. In other words, 36 is more like nervous and grumpy than end of days. Now, does slightly fearful sentiment sometimes set the stage for rallies? Absolutely. There's a reason people say markets climb a wall of worry. But the argument, we're at max fear, therefore we're about to soar, is oversold when the indicator is literally sitting closer to neutral than to the abyss. So, verdict on this one. He's right that sentiment isn't euphoric. There is lingering nervousness. But labeling 36 as max fear is just rhetorical spice. It's more accurate to say Investors are cautious, but not capitulating. That's not nearly as clickable, but it is closer to reality. Next, let's talk about the big bad Fed and those alleged floodgates. Tom says something like, "The Fed just opened the floodgates with a rate cut and the beginning of quantitative easing, implying there's this huge new wave of liquidity that's going to launch equities." We need to separate three things here: rate hikes, rate cuts or pauses, and full-blown quantitative easing, QE, where the Fed expands its balance sheet by buying bonds. By the time investors on YouTube are talking about a specific Fed move, markets have usually been pricing it in for weeks or months. Futures markets like Fed funds futures basically handicap the odds of rate moves in advance. So when the Fed cuts or signals they're done hiking, a lot of the good news is already baked into prices. On QE, that word has a specific meaning. During real QE, like after 2008 or during COVID, the Fed's balance sheet balloons because they're actively buying treasuries and mortgage-backed securities in size. You can see it in the weekly 8.41 reports. The line goes up a lot. More recently, the Fed has been mostly doing the opposite, quantitative tightening, letting their balance sheet slowly run off. You can have a rate cut or a pause without turning on some giant new QE program. So when someone says, "The Fed just opened the floodgates and started QE again," you want to check, did the Fed actually announce a new asset purchase program? Or did they simply shift guidance and maybe tweak the path of policy rates? Historically, easier policy, cuts, or even hints of cuts, is supportive for risk assets like stocks. But supportive is not the same as guarantees a 15% rip in 2 weeks. And it's not a brand new surprise if the market's been expecting it. Also, sometimes you get buy the rumor, sell the news. The cut comes, everyone says, "Cool, we knew that," and prices actually dip. So verdict here. Directionally, Tom is right that a less aggressive Fed is a tailwind, not a headwind. But floodgates and beginning of QE is more dramatic storytelling than careful description, unless we're actually seeing a fresh, explicit QE program with the balance sheet ramping. Always check the policy statement and the Fed's balance sheet, not just the vibe. Now onto one of the spicier claims, that short-term pullbacks are designed by institutional players to shake out weak retail hands so they can buy cheaper. This idea is super popular on finance YouTube. There's this shadowy group of institutions coordinating to trigger drops, scare you out, and then buy your shares on sale. Here's the boring, less cinematic version of reality. Institutions absolutely move markets. They trade huge sizes. They use algorithmic strategies. They have risk models. They do portfolio rebalancing. And toward year end, they may do things like tax loss harvesting, selling losers to lock in losses, and window dressing, tweaking holdings to look better in their quarterly reports. All of those flows can increase volatility and sometimes push prices around in ways that feel random or cruel if you're looking at your Robinhood app every 5 minutes. Market microstructure research, yes, that's a thing, shows that when a lot of systematic strategies are leaning in the same direction, or when liquidity is thin, small bits of news can trigger exaggerated moves. It can absolutely feel like someone is hunting stops when, in practice, it's a bunch of uncoordinated but similar algorithms and mandates all firing at once. What we do not have good evidence for is a coordinated cabal of institutions sitting in a dark room saying, "Let's drop the S&P exactly 3% to shake out retail on Tuesday." There are millions of participants, from pension funds to hedge funds to high-frequency traders, all with different incentives and time horizons. They can and do profit from your panic, but that's not the same as explicitly designing the panic every time. So my verdict, there's a kernel of truth. Sophisticated players are better at using volatility and liquidity than retail investors, and their flows can create the kind of shakeouts Tom talks about. But the confident claim that pullbacks are designed specifically to screw you is speculative and veers into conspiracy. Don't build your strategy on the assumption that there's a single puppet master. If you want to be less of a victim, the solution is not to fight the imaginary cabal. It's to have position sizes and time horizons that don't force you to panic sell into every 3% dip. Next up, Tom's bullish tailwind about underperforming fund managers. He argues that a lot of money managers who lagged the market this year are dying to jump in near year-end to catch up, which could add big fuel to a Santa rally. Basically, career risk forces them to chase performance into the close of the year. This one actually has some academic backing, but it's more muted than YouTube usually presents. There's research on window dressing, where mutual fund managers buy recent winners and sell ugly losers near quarter or year end to make their holdings look better in reports. There's also work on performance chasing, where funds that are behind their benchmarks take more risk late in the year, loading up on high beta or momentum stocks. These behaviors can create extra buying pressure in certain segments, popular growth names, big index winners, around calendar boundaries. But here's the catch. Studies generally find the effects are modest and inconsistent. They might move specific names or sectors more than the broad index, and some years the effect is tiny because managers aren't as far behind or they're more risk-averse. A wave of underperforming managers does not guarantee the S&P pops 5 to 15% in 2 weeks. Could it add a bit of upside bias, especially if sentiment is already improving and the macro backdrop is friendly? Yes. Is it a reliable force you should bank your rent money on? No. So verdict. Plausible as one ingredient in the stew. Fund flows, sentiment, seasonality, Fed stance, but nowhere near strong enough to justify treating a big rally as almost certain. Now let's get to Tom's most precise and dangerous claim, the actual play-by-play. He sketches a scenario where we get a fast 2 to 4% drop on the S&P 500 over a few days to shake off weak hands, followed by a 5 to 15% rally in the last 10 to 14 days of the year. That's an extremely specific short-term forecast, and that's where a lot of retail investors get hurt, taking point forecasts and turning them into trading plans. Let's bring in some numbers. If you look at the S&P 500's daily history, 2-week moves of 5 to 10% do happen, but they're not everyday events. Big moves are usually associated with major catalysts, financial crises, huge policy surprises, major geopolitical events, or the end of brutal bear markets. A smooth, calendar-based 5 to 15% rise in a quiet 2-week window is not the typical pattern. Possible? Yes. Common? No. More importantly, professional fund managers with PhDs, teams of analysts, and access to order book data cannot reliably predict that we will drop X% this week, then rise Y% next week, often enough to build a career solely on that. Short-term forecasting skill is extremely scarce. The vast majority of funds underperform the market over long periods, even with better tools than any of us have on our laptops. And here's the psychological trap. If this year happens to follow something like Tom's script, say we drop 3%, then rally 7%, it will feel like he called it. The human brain remembers the hit and forgets the hundreds of other precise predictions made by various creators that never played out. Even if he nails this one perfectly, that does not make the underlying method repeatable. A broken clock is right twice a day. A charismatic one can be right twice and sell a lot of ad inventory. So verdict on the very specific 2 to 4% down, 5 to 15% up script. Treat it as an entertaining scenario, not instructions. Scenarios are useful to ask, what would I do if we dropped 4%? What would I do if we ripped 10%? But if you start trying to time both legs based on YouTube confidence, you're not investing. You're speed-running regret. All right, let's land this with what you can actually use. From Tom's video, here's what I think is genuinely helpful. First, the idea that short-term pullbacks in an overall uptrend are normal. Whether or not some institution designed them, markets rarely go up in a straight line. If a 2 to 3% dip makes you want to liquidate everything, that's a signal your risk is too high, not that the market is broken. Second, understanding that sentiment and positioning matter. If everyone is euphoric and leveraged to the eyeballs, risk is higher. If people are cautious and underweight, there's more dry powder. Tools like the Fear and Greed Index, fund flow data, and positioning reports from major brokers can give you a rough sense of where we are on that spectrum. Third, recognizing that seasonality and policy can be tailwinds. Late December has, on average, been kinder to markets than some other periods. A Fed that's done hiking is less hostile than one slamming on the brakes. These are all inputs into a risk-return picture. Now the hype bucket. Overconfident, precise, short-term predictions like we're about to drop 3%, then rip 12% in 2 weeks. That's not a plan. That's a screenplay. Calling a mid-range fear reading max fear. It sounds dramatic, but it distorts what sentiment is actually telling you, implying that institutions centrally design shakeouts. Yes, the game is tilted toward people with more capital and better tools, but there isn't one puppet master pressing the dump retail button every Thursday. So what should you actually do if you're staring at your portfolio, wondering if Santa is coming or if you're about to get grinched? Step 1. Decide who you are. Are you a trader or are you a long-term investor? If you're a trader, fine, you live in short-term land. Just be honest that you're playing a hard game against faster, better-resourced players. Use position sizing, defined stop losses, and a written plan that doesn't depend on one YouTuber's scenario. If you're a long-term investor, which is most people watching this, your edge is time, not clairvoyance. You do not need to catch every wiggle. A 2 to 4% move in either direction over a week or two should not change your entire strategy. Step 2. Build your process around things you can actually control. Your diversification across stocks, sectors, maybe bonds or cash. Your time horizon. How long before you need this money? 5 years? 10? Your risk tolerance. How much drawdown can you stomach without panic selling? Step 3. Use bold forecasts as stress tests, not orders. If someone says, we might drop 4%, then rally 15%, ask, if we drop 4%, will I panic and sell? If yes, maybe I'm too aggressive. If we rally 15% without me going all in, will I feel like I missed out? If yes, maybe I'm too glued to short-term noise. Your job isn't to perfectly time Santa. It's to avoid doing something dumb when Santa is late, early, or skips your house entirely. So, will the Santa rally save your portfolio? Maybe we get a nice little year-end bump. History says the odds lean slightly positive for that specific period. Maybe we don't, because macro earnings or some left-field event decides otherwise. What matters much more is whether your portfolio is built to survive whatever January, March, and next October throw at you. If you found this breakdown helpful and you want more, does this YouTube claim survive contact with reality? Content? Tell me in the comments. Are you more afraid of missing a rally or of sitting through a crash? And hit subscribe so you don't have to face the next critical warning to all investors alone with just a fear index and a Christmas meme. This has been The Comment Section with Thomas Paul. I'll see you in the next one.